Hello, everybody. Welcome back to Beer and Money. On today's episode, we're going to be talking about taxes. It's tax season, and a common question I get is how to lower taxes. And the big thing that I think we need to start with, and this is going to be a three-part episode. Today's episode is really going to be understanding how taxes work. And so on today's episode, we're going to be talking about what is this marginal versus effective tax bracket? What does that mean? How do the taxes actually work? Like, how are you taxed? And then lastly, I think there's a misunderstanding about how our bonuses are taxed. And so I'm going to go into those pieces today. So without further ado, let me jump into it. So I'm going to share my screen. If you haven't checked us out on YouTube, make sure you check out our YouTube channel. That will have the visual side of a lot of our episodes, which we are transitioning to really show the numbers and how everything kind of operates. So if you're listening into the car, maybe bookmark this one to come back if you're really wanting to understand how taxes operate. So you should be seeing my screen now. What I'm working with is I'm going to work with the client. Let's just say that their taxable income is $400,000 a year, right? So they make 400 grand and their taxable income is also $400,000. For today's episode, I'm not going to take into consideration standard deduction. I'm just going to keep this very high level and show you how taxes actually work. And so with $400,000 of income, you can see that the tax bill would be $83,373. Now, this is without tax deductions, child tax credits, all that kind of fun stuff. This is just, again, high level how your taxes work. So as you can see, I think the first thing that we have to understand is some people will see that their marginal tax bracket is, in this example, 32%, and they think all of their money is taxed at 32%. That's their marginal tax bracket. And what that means is your marginal tax rate is the rate that's corresponding with your highest bracket your income falls into. Here's what that means. The $400,000 that's coming in the door, the first $23,000 that this person makes, now this is 2024 tax brackets, just a quick heads up for you, is taxed at 10%. And then the next, I'm going to round up here, the next $70,000 that this person makes is taxed at 12%. The last, call it $17,000, $16,100 that this person makes, that's what's taxed at 32%. So not all of their money is taxed at their marginal tax rate, which is 32%. Their effective tax rate is 20.84, almost 21%. And what that number is if you were to take the total taxes owed, in this case, the 83,000, and you divide it by 400 grand, which is the taxable income, you'll get almost 21%. That's their effective tax rate. So not all of your dollars is taxed at one tax rate. It's a graduated taxable bracket system that we've got here. Okay, so that's number one. That's the difference between marginal and effective. The other piece is, how does your bonus get taxed? Now, in this example, they're already in the 32% tax bracket. That's their marginal rate. For them to jump into the 35% tax bracket, they would need to get above $487,000. So here's the example. Let's just say this person got a $50,000 bonus. So now their income is $450,000. Their taxable income is also $450,000. So how they'll be taxed is, if I can get the math correct here, how they're going to be taxed is this. That bonus, that extra 50 grand is taxed at 32%. Okay, that's how their bonus would be. Now here's another example that I'll go into real quick here. Let's just say their income was $450,000 and their bonus was $50,000, meaning their income ended up being $500,000. Okay. So I'm going to show 500. So those of you looking on the screen here, now we're looking at scenario 2. And I'm including their bonus. Now you can see their entire, the money that's above and beyond $487,000, that is now taxed at 35%. You can see now they're entered the 35% tax bracket. So how your bonus really gets calculated is whatever your highest marginal tax bracket is prior to the bonus, you'll be taxed at that bracket unless, in this example in scenario 2, you're on the verge of being in another tax bracket. So I wanted to go over this with you because this is really, really key, because when we look at planning and we're looking at forward thinking here. So now let's back up for just a second. If we know how tax brackets work and how tax system works, we know our marginal and effective tax rate, where we're saving money today matters. Meaning, when you put money into a retirement account, a taxable account, wherever you're putting the dollars, what you should also consider is how is that money going to be taxed when it distributes back out to you? We've had episodes on this in the past. So if you're putting money into a traditional 401k, meaning it's pre-tax money, you put money that has not been taxed into your 401k, it grows tax deferred. But then when you distribute to yourself in retirement past the age of 59 and a half, every dollar that comes out is fully taxable and it lands in this tax system. Okay. Versus a Roth account, now it's after-tax dollars going into that account, into your 401k. It grows tax deferred. And if you pull it out past age 59 and a half, that money actually goes to you tax-free. So the big conversation, a big thing that oftentimes I have with clients, especially when they first sit down with me, is, are you putting money into traditional versus Roth? And how did you make that decision? Oftentimes I sit down with them and the bulk of their assets is sitting in that traditional 401k because that's what we were told to do for most of our life. And we have not considered what's going to be the taxable income when I turn my assets into an income stream when I no longer want to work. And if you have the tax system like this and you can have different buckets of money, that's how you can leverage your tax brackets in retirement and possibly control the tax bracket you're in. So that's it for today's episode. I wanted to go into this because, again, it's tax season. Your CPA is going to be coming to you and trying to lower your tax bill as much as possible. And that's a good thing to have, don't get me wrong. But another piece that you should bring up to your CPA is, okay, how do we consider taxes 20 years from now or 15 years from now when I start to distribute my assets into income when I no longer want to work? And that's where you should be bringing in your financial advisor, financial planner to coincide and work with your CPA so they can be on the same plan. Because oftentimes the CPA is just trying to save you taxes this year. They may not be thinking about what the tax implications might be, because they might come to you and say, hey, Mr. Miss Client, you should put extra money into a traditional IRA, for example, because that's going to lower your taxes this year. But what does that do for your taxes 15 years from now when you turn on the income stream? You have to look at both sides. And so that's what today's episode is all about. I hope this episode was valuable for you. Make sure you check us out at beerandmoney.net. At the top of the page, there's a contact us. If you have any questions around this, feel free to reach out to us there. There's also going to be a link in the show notes. If you want to do a financial, let's just say financial scorecard and do your own scorecard, there's going to be a link in there and you can log into the link and it'll give you a scorecard. It starts to tell you how you currently look, how you look on the protection side of stuff. How do you look from a cash flow and liquidity? How do you look on a debt? And it gives you a high level overview of what you look like financially. So I hope this episode was valuable for you. As always, cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7492237.1, expiration date January 2027.